Well, good afternoon, financial professionals. Dan Peterson here. I'm president of E4 Insurance Services, and they're going to let me out of the box today and actually participate in the brew. So thankful for that. Thanks for tuning in today, and for those of you joining the brew, building relationships every week, for the first time, I'd like to welcome you and start the brew by one of our traditions, which is celebrating today's National Day. So today's kind of a big day. We have a couple of national items, things like National Peanut Butter Cluster Day and also National Proofreading Day. So if you've never met Barb Wirtz in our office, this is her day. She loves to proofread. But it's also an international day. It's International Women's Day. So to all our women advisors and women in our teams and women in our lives, happy International Women's Day. On today's brew, we are welcoming Abacus Life's Director of Sales, Stuart Little. So Stuart, we got to get it out of the way. It's E.B. White was one of my favorite childhood book authors. The Trumpet of the Swan, the Charlotte's Web, and Stuart Little. How, any relation or correlation there that we should be aware of?
Not necessarily, but the only correlation I'd like to have is if I can get a little red sports car to drive around, and maybe if we get enough business off this call, that might be a reality for me. So.
Well, and Stuart, I understand you're also not Stuart Little. You're 6'5", so anybody who really wants to get you a little red sports car is going to have to upgrade. So,
yeah, that's right.
All right. Well, we do have Stuart, and I'll let him introduce Dan Brown as we go forward. But thank you for joining us today. We're happy to learn, and again, as financial advisors, it's really important. We work with a lot of financial advisors who manage money, manage assets for their clients. And one of the things I wanted to jump right in at the start, I know you're going to share some cases with us and ways that we can think of the whole issue of life insurance and life settlements and how that can translate into financial planning. But your firm, Abacus, is a vertically integrated alternative asset manager. That's a lot of words, but that specializes in life insurance products. So maybe help me understand, or help our team here, Stuart, understand really what that means and what that is, what Abacus is.
Yeah, Dan, thank you, and I appreciate that. Yes, we're very fortunate to be on this call. I want to open some doors to the reality of life settlements and from an investor's point of view. For the longest time, this was smoke and mirrors transactions, and instead we want to make this something that is effectively part of your overall portfolio from the client's point of view, and we want every client to look at this the exact same way that we do, which is as an investment. So real quick, I'm going to introduce Dan Brown. He's the dedicated account manager to E4. We're going to highlight a lot of information in a little amount of time, so bear with us here. But if you want any sort of additional follow-up, please coordinate with E4, and Dan Brown will be able to assist in making sure you all walk away with a deep understanding of life settlements. So can everyone go ahead and see my screen here? Should be up and running.
We can.
Perfect. So yes, Abacus Life is an alternative asset investor, an alternative asset fund. And our goal is to acquire life insurance policies as a non-correlated asset class, just as any other investment is acquired. We utilize Abacus Life as the providing entity, as the origination machine, but effectively we represent a number of institutionalized funds, and some large institutionalized funds such as KKR, PIMCO, Apollo, that exclusively utilize Abacus in order to invest into a life insurance policy as a non-correlated asset. And our goal has always been, we have too much demand versus supply. How do we level that out? because there are billions of dollars that's sitting there on the sidelines trying to invest into life insurance policies as an investment. And the reality is there is a steep learning curve from a client's point of view that life insurance is not a liability, but instead it is personal property that they own and that they're building equity in over the life of the contract. So we've run a few focus groups, and we've asked kids of seniors, we've asked senior citizens, we've asked financial advisors, and we asked them, what are the top 3 assets that you own on your portfolio? Guess how many of them said life insurance? It was less than 1%. Yep, less than 1% of them said that life insurance was one of the top assets that they own, when in reality, it's simply just solving for the net present value of that death benefit today. Not only that, is there's roughly $200 billion that's lapsed back to the insurance companies every single year. 90% of those seniors that lapse their insurance policies back to the carrier would have considered a life settlement if they knew it existed. And the key statistic to this, and hopefully you'll be able to see just how important it is to tell all of our clients that this option exists, is roughly 76% of universal life policies sold to seniors at age 65 never pay a claim. It's 3/4 of life insurance policies that are simply forfeited back to the insurance carrier as opposed to paying out at the death benefit at the end.
So Stuart, there's a real lack of awareness then. If only 1% of Americans view their life insurance as one of their top assets that they
That's
own.
Right.
What is the target audience? What for advisors and financial advisors, really? Maybe you can go into some ideas of what that target audience would look like that our financial advisors that we work with should be considering.
It's a great question, and I wish I could say that every policy that is surrendered would qualify for a life settlement, but the reality is this is still an investment where there is a significant duration cost in terms of time value of money that's factored into our analysis. So we generally recommend starting this conversations if the insureds are healthy at the age of 75 and above. And the reason being, and simply put, is that puts their estimated life expectancy right at around 15 years or less. And traditionally, that's about the threshold that creates a profitable investment for us, while we can still offer a large enough net present value to make the client interested in moving forward. If they're younger than that age range, that's completely fine. The fact of the matter is, though, they need some type of drop in health in terms of different impairments in order to lower that life expectancy down to around 15 years or less.
Okay.
And then traditionally, the main products that we buy are going to be universal life products. Specifically, I've got a case study here that I can mention, Dan, that highlights just some of the key specifics of the target audience. And so
this is somebody 84 years of age. That's not too old, I guess, from that standpoint.
There's no maximums. Ideally, it's a simple net present value calculation. And so if the life expectancy and the duration is short enough or even high enough, then if we can get a positive net present value calculation, then we can offer on the policy. It's the same methodology, and that's how we create value for the client.
Okay.
Yep. So Sierra was an 84-year-old female. She had a $1 million universal life product. What I love about this case is she had actually signed the surrender paperwork to collect the $62,000 in cash value. She no longer needed the coverage. Her kids were grown, and effectively she was tired of paying those premiums. And so the agent and advisor saw that she had done this, and instead of just allowing her to continue forward with surrendering it, he called me and said, "Stuart, just real quick, I've got this potential case. What do you think we could get?" And so I assumed a standard health valuation, and it turns out the policy's net present value was worth $150,000 put back into the client's pocket. It's around 2.5 times what she would have gotten from the insurance company, because all we're doing is solving for what that $1 million is worth today. And in this instance, it was worth roughly 150 grand. There's agent commission that can be made on top of that. And the total time to complete this was simply a month and a half because I knew she was in standard health to begin with. I didn't need to underwrite or get life expectancy.
So the 62,000, her intent was to donate that to her church, her religious organization, and she was able to give a 2.5 times larger gift, in essence, to her church, just based on this transaction.
Yep, that's exactly what happened.
Wow. Okay. And it only took 48 days to go through that process. What's involved in that process?
Yeah, so it depends on the case. But if I have a policy that works without needing medical records or life expectancies, I can generally put offers out within a matter of 48 hours. That said, if there are certain policies that require some drop in health, or if the clients do have impairments, we try to always get updated medical records for them. But there's no real need for the client to go see a doctor, or there's no need for a paramed exam. My team will do all the work, and we simply go and get medical records. We pay for life expectancies, and then we can figure out the net present value from there. After that, it's a simple closing process where we work with you to effectively get all the proper owners to sign off, and we switch ownership and pay the client.
All right. So we have a question actually that's popped up because most of us are familiar with taxation of if Sarah had cashed in her policy and she was paying $48,000 a year, obviously she's going to have a pretty significant basis in her policy with that type of premium structure. She's only getting 62 back, so everything she gets back would have been return of her basis, so no tax on that 62,000. With the 150,000 that she would have received, how's that taxed? Chris is asking. Chris is asking, how is that taxed?
That's a great question. And I'm not a tax advisor, but I'll say kind of our general guidelines are, it's all based off the cost basis, where if they receive more than what they put in a life settlement, it's a little different than normal. It's actually long-term capital gains. So we can provide a brochure and to ensure you will get that cost basis at the end of the transaction. And then you can simply solve for if there's any gain or not from there. The only difference is if the cash value is above the surrender, or the cash value is above the cost basis, but I very rarely see that. Most of the time clients are coming to us with policies with cash values lower than the cost basis.
Lower than the cost basis. Okay.
That's right.
So instead of ordinary income, in the case of a policy with cash value greater than basis, this would be a long-term capital gain based on the sale of it.
That's exactly right.
Okay.
Yep.
All right. Did you have another example you wanted to share with us?
I do, but I wanted to take a moment, Dan, to talk a little further about why it's so important for advisors to be aware of this.
Great.
What I've found is that traditionally in life insurance, the writing agent simply doesn't keep up with the insured or the owner of the policy the way that they should long term. And what happens is financial advisors are consistently asked, what should I do with this life insurance contract? Trustees are finding themselves in liabilities of owning and managing life insurance policies that they simply don't know what to do with. So every financial advisor should be aware of this, because the last thing I think anyone can afford to advise on is to lapse a policy that could potentially receive 2 or 2.5 times what the carrier would give. So first and foremost, just understanding that a lot of clients are very interested in this. They just don't know how to access it, I think opens up more doors for our financial advisor relationships. In addition to that, this is also recommended by the NAIC for long-term care financing. It's a part of a total portfolio audit. I mean, I can't tell you how many times I've been able to help clients with their long-term financial planning while using life insurance as an asset as opposed to a liability. There is a lucrative commission structure, but at the end of the day, clients are interested and they simply need professional assistance. And so what Abacus has done is we've designed our model to be just like an insurance company. We want to make sure this is a very easy transaction for our partners to take advantage of, because oftentimes the feedback is it's just such a foreign business and a foreign concept. I don't want to get involved in it. When in reality, this can be a significant transaction for clients to utilize. On top of increasing financial advisors AUM, if you can give the client significantly more capital than the insurance company, you're a hero at that point. And we think clients deserve to know about this. And so Abacus has been in the business of buying policies for about 20 years. And kind of a fun little tidbit is when I first started here around 5 years ago, I was employee number 15, and now we're up to around 80. So the demand for life insurance policies is there, and more clients are aware of this. They see TV commercials, they see online advertisements, and we want to pull that business back into the financial professional. On top of that, we've been through extensive due diligence, and we offer a $5 million E&O coverage plan for life settlements as well. That way you have that extra protection.
And Stuart, we've Steve Berge on our team heads up our life settlement area and has worked extensively in this marketplace. We've worked with a number of providers, brokers, people who go out and shop for this. Abacus is a little different in that investment party.
That's right.
And then purchase the policies with no middleman. Can you explain that a little bit for our audience?
Yes, I really appreciate that question, Dan. Investors realized that there was significant compensation being paid out to a third party that was not creating the value they said they were creating. And so what happens is the demand for policies compressed yields, and simply the offers for policies are significantly higher than they've ever been, which eliminates the necessary middleman to say they're going to quote unquote drive value, when in reality, the policies have value based off 3 simple components. They have value based off of the duration, what's the life expectancy of the insured, what's my cost of insurance that I have to put into the policy, and then what's the discount rate I'm going to try to earn on my money. And from an investor's point of view, they need to buy policies at a rate that they are unable to find. And so they want strong valuations out the door so that they can continue to drive more volume for life insurance policies, as opposed to just trying to win on one case. And because we've transitioned kind of a transparent valuation model, and we've eliminated a lot of middleman out in this space, we've actually paid out significantly more per policy to the end policy owner than other companies in this business, and roughly 35% more than our leading competitor. And that is simply because we believe in offering all the information, the numbers, the valuation reports. We want our clients to look at this the exact same way that we do. That way, it's determined if this is the right decision or not simply trying to compare it to a smoke and mirrors transaction and then hoping they say yes. And oftentimes what we find is that the clients agree with us and they believe that this is the best option for them to take advantage of, especially if they no longer want to pay premiums.
And sometimes, I know we all have seen maybe the Coventry commercial of people no longer wanting or needing their life insurance and those kind of commercials that we see in various TV stations. But this isn't just elderly, 75 plus market either. I know we've been involved in some really successful cases where a business may be wanting to get cost recovery of some case with where they owned a key person, a term insurance policy, and rather than cash that in, the employee insured had some health issues. The policy was still convertible. We were able to give maximum offer to the client, to the employer, and the advisor was able to convert the policy and receive a commission on that piece of it. So there's a lot of creativity, isn't there?
Oh, absolutely. Dan, that's such a good case study. I mean, anyone that owns life insurance policies on the book should know whether there's a fair market value or not. Whether it's owned by a business, a trust, an individual, a company, a charity, anyone that owns life insurance should know the fair market value. And so what we did at Abacus was we created a very easy tool to determine if a life insurance policy has that value or not. We've taken years of pricing data and created a very simple policy value calculator that you input just simple information, age, gender, death benefit, and policy type, and it will calculate based off our COI averages, the potential ranges for the policy. And so you can see that if the client's standard health based off this policy information, they can receive around 50,000. But if the client has more impairments, they could potentially receive $200,000 to $250,000. And this is the type of valuation that we want all of our clients to understand, is that it's a simple duration model, time horizon drives value, and it's our job to figure that out.
And at E4 Insurance Services, we've actually implemented this calculator, and you've been great to be a partner with us to implement that right onto our website. So when advisors log into our portal and they're in our portal, they can go under resources and actually see this and run this calculator themselves.
Yep, that's exactly right. It's a completely free service. A small tidbit as well is we also can do this on a larger scale. So if you have a book of business or if there's a portfolio of policies, I can run this same calculator on every policy at the tune of around 8,000 a minute. So there's not a book that's too big for us. But Dan, I also wanted to talk a little further about how to get maybe more specific information. I know we're running out of time here, so
Yep.
I've only have one or two more slides. But if you are interested in learning what the potential fair market value is for a life insurance policy that your client owns, we've got a very simple preliminary quote process. All I need to start is just an illustration to age 105. If possible, even if it's younger than that or older than that, I can still run estimates, a simple date of birth and a brief medical history. I get those three pieces of information, my team runs estimates, and we're able to provide you with the best next steps from there. So on top of the calculator, we also offer more individualized pricing models for you.
And we have all of that. Our team is standing by ready to assist on all of those steps in gathering that information, gathering the in-force, doing all of that, and providing that over to Daniel and you, Stuart.
Perfect.
Abacus. Yeah.
Yep, exactly right. So we'll coordinate and work together to make sure you all get the process and the information necessary to move forward. I wanted to end this real quick, though, with one last case study, Dan, if that's okay. I think this showcases a different way to look at life insurance, even up and above solving for the net present value. And right now, you noticed and saw just receiving an immediate lump sum of cash, but there's also a way to offer a portion of the death benefit to the insured's beneficiaries. And so Robert, he was an 81-year-old male. This was an $8 million existing universal life product. He had a few impairments, so we went and got medical records and underwrote on him. But effectively, he can no longer afford the $320,000 a year. He missed a few premium payments over the life of the policy and was unable to pay that increase in cost. And so instead of just using the existing cash value to pay for a paid up policy, we actually ran our valuation assuming we would leave his insurance trust on for $3 million of what's called retained death benefit. My fund still takes on all premium responsibility, all ownership rights, but from the beneficiary level at the carrier, his trust is listed for 3 out of the 8 million, and my company's listed for 5 out of the 8 million. The agent was still able to earn commission, but at the end of the day, he was able to get significantly more in retained death benefit versus a paid up policy. And so if you're interested in that as an option, connect with E4 and they can give you that, they can pass that information along to us to make sure that we can look at the case the right way for the client's needs.
So very specific targeted planning that wasn't just a dollar amount back to Robert. This was very specific targeted planning towards the estate tax or estate planning needs that they had, and this
Mm-hmm.
was the solution that fit them best to provide some of that really good liquidity at death.
Yep.
Okay.
That's exactly right. And we can do a
Well,
hybrid of the two as well. But
yeah,
these are some of the great options that
that's
you
great
pick.
to know. Thank you for
Yeah.
sharing that. And I've been part of the Red River Estate Planning Council, and when you talk about investment portfolio reviews and audits, as advisors, we need to get this word out, because a lot of CPAs, attorneys, advisors don't realize the valuation that is available on this asset called life insurance. So it's important for us to do that. Well, thank you very much, Stuart. This has been very informative, and let's see if we have any questions. If there's any questions that have popped up.
Dan, I think we did a great job here based off what I can see.
Yes, we've got, we talked about tax consequences. We talked about how long it's going to take. We had, I guess one question that I did see pop up: if someone wants to buy the policy, shouldn't the client just keep the policy? That does come up sometimes.
Yeah. I think that's a great question to kind of speak to. Is what I've found is that the answer is, if the client needs or wants and can afford the policy, they should absolutely keep it. They can simply know the fair market value regardless, but I want them to obviously own the property that fits their needs. But the key component to kind of how we create value versus how a individual would is, because we have a large portfolio of life insurance policies, what we can do is what's called optimize the premium cost, meaning I'm just going to pay the absolute bare minimum to minimize my cost into the policy. But what happens, and what's the consequence of that, is that increases my back end risk. So if the insured lives longer than my estimated models, well, I'm on the hook for paying that increase in cost. From an individual's point of view, I think the general consensus is always to level out those premiums, because that decreases the back end risk, and you should look at this a little more conservatively. So I offer the net present value based off my optimization valuation, but the net present value for them could be actually a lot less. And so we talk through what that looks like and if that makes sense for the client to move forward with. But because I have thousands of other lives and $1 billion to pay premiums, I can accept that risk, as opposed to an individual that only has a couple policies and a finite amount of funds.
Well, that's great. Well, I'd like to remind everybody, Stuart, that our Today's Brew broadcast and our full library are all recorded and shared on our Brew blog, easy for me to say, on our website, and at www.e4.insurance. So be sure to check that out. And Stuart, we always wrap up with a giveaway. So Starbucks gift card. And as we're doing that, can you pick a number between 1 and 25?
20.
Number 20. Let's see. Who is the winner today? The winner is Debbie Struthers. Congratulations. You've won a gift card, and you'll be receiving that in the mail. And thank you for joining us today. Stuart, very much appreciated. The very, very timely and pertinent subject for us. Again, Steve Berge and our team heads up our life settlement area and really has done a great job in building that for us. And we're excited to be partnering with a direct buyer of these products with Abacus, and appreciate the time that you've taken today. I would remind everyone to join us next week as we welcome Prudential's Individual Life Insurance Division Regional Vice President Dan Davies. Dan will be share with us an overview of the private placement life insurance market, private placement, PPLI or PPVUL, including product features, benefits, working with registered investment advisors, and how to get started in identifying solutions with PPLI. We'll see you next week on The Brew. Thanks, everyone.